Do we up our cash balances? Do we increase our options in terms of what kind of volatility we're expecting? How do I take what we've just been hearing about and turn it into portfolio theory?
Well, huge number of moving parts. So I think the first thing is, of course, dealing with the trade war situation itself. Do you think it's going to escalate is, of course, your first question. Because if you don't think it's going to escalate, if you think the midterms and the need to have a rising stock market, a falling unemployment rate is really going to limit the administration's agenda here, then you stay pro-risk. But then you also need to think about, let's say that scenario doesn't play out, the other moving parts. And I think the one the market's particularly questioning or unsure about right now is, well, how does the Fed play in here? How do the central banks? Because, of course, start of the year, it was all about global policy normalization. Will we actually find out the Fed are much more supportive and will actually really put on hold some of their plans? So huge number of changes. But essentially for us, we think it's about looking through some of this trade noise. We don't think it's going to escalate. And the underlying tailwinds for corporate earnings, I think, are still very good.
Jerome Powell, the Fed chair, speaks on Friday. How much of what he says will be dominated by what we've just heard?
That's a big question. I personally think the market has got itself into an assessment of Powell and the Fed under Powell, that it's going to be much less reactive today to much less supportive, that it's, if you like, got itself on a path of normalization. It's decided it wants to get back to normal, and it's going to take a lot of downside news to pull it off this projected path. I'm not so sure. These central banks have worked really hard to generate these recoveries. There's still not that much signs that inflation's coming through in a significant way. Maybe we'll find out when he speaks on Friday that they are a bit more data dependent. They're going to take some of this bad side news into account more than the market currently thinks.
Karen, good morning. The distractions are there and all. What is the core JPMorgan Asset Management call on what I should do with my money? Forget about trade. Forget about Brexit. Forget about Guy Johnson's 3-week vacation coming up. What do I need to do with my money as we begin the second quarter?
I think you have to look at the underlying momentum for earnings, which still, even stripping out the tax effects from the States, still looks very strong. If I think about decomposing that earnings outlook into top line, where firms are clearly getting a little bit more comfortable about pricing power, particularly in certain sectors, but there's still not a lot of wage growth. It still seems firms are able to push down on costs. Then I think the outlook for earnings is still very strong. And I think the central banks are going to be reactive. They're going to keep trying to push that recovery along. So it's still a very pro-risk tilt in our view.